So today is February 6, 2015. It's just about 1 o'clock p.m. And looks like Nxpi is trying to break out. Now, it's not getting a cooperative market just yet. The markets are yellow. They look like they're trying to trend upward, but there's not a very strong trend in the upward side today. And for the week, although we have a trend in place, it's not a very high volume trend. So who knows if it's going to stick around. We have to wait until the market goes green. But fair warning, Nxpi Semiconductors is a company we've been watching for a while. It's had several little incremental breakouts, but no real breakouts. So let's take a look at the weekly on it first. You can see here on the weekly, there is a box that gets drawn from high to low. So this is a consolidation area. And there's another consolidation area basically right above it. Now you can draw it two different ways, but this is a box on top of another box according to Nicholas Darvis. That's the way he traded. And you can see that we have this little tail sticking up here above this box. Right now it's in the range of this box, so it's technically still in the consolidation. But look at the volume. You can see we had some high volume on the doji candle the week before, but this week we are already exceeding that volume. The Genius indicator is in the upward side and it's still trending upward. And it looks like if we get some more volume, this thing might break out. Now we have, I think there's an $96 target price on it. Funny enough, Raymond James has an $85 target price on it. Now, you can use either one that you'd like. The stock is currently trading at $82.64, so a $2.50 gain is still pretty good. We like the $96 target price based on our ABCD analysis that we did, and we let you know about it a couple of weeks ago. So we see this stock going up. Now, let's take a look at if it were, we've got some options on it, and we think you could play some options on the stock. Let's take a look at what we would do if we could enter in an option play today. So right now is February 6th. We got 14 days left on these February 20th options. And if we go to the stock is 82.71 and the target price just slightly in the money by 20 cents is 82.50 on the calls. You can see the calls are trading 205 bid by 220 on the ask, and they're worth about 260. So they're kind of on sale according to the Black-Scholes model. There's a 53 cent delta on them, which means that if the stock moves $1, the option is going to move about 53 cents. So if this stock can go up to 85 or 87.50 or 90, now that's probably not that likely unless we have a solid green market coming up here on Monday or Tuesday, and we get the stock working in our favor and everybody gets excited about it and there's a lot more volume that builds into it. That could very well happen. Remember, 40% of all breakouts do fail. But let's say that all happens. This 220 should go up about 53 cents for every dollar that the stock goes up. Now, you want to put your stops pretty short on this. So I would say put it 20 to 25% under your entry price and do it right away so you don't get emotional about your trade. But taking a look at how we would do this, I would either do the 220. If you want to do a little short-term trade, the other ones have a nice price to discount ratio here. It's $1 by $1.10. The Black-Scholes model says it's worth $1.55, and that's out of the money. And the stock's got to get up close to 85 here in a couple weeks. I don't know if that's that likely. So we might want to look at, instead of doing the Februarys, let's look at doing the Marches. So here's how the Marches look. Still a discount. There's the Black-Scholes says it's worth $4.52, and right now it's trading $3.50, $3.90. You probably can pick it up for $3.80, let's say, something like that, and get even more of a discount on the ask price. That's the 82.5. You want a little bit more bang for your buck, provided the stock moves up. 245 by 260. Black-Scholes still says it's worth $3.42, so you're getting you could get almost $1 discount on the 85s. If you really want to be aggressive, you got to hope that in 6 weeks this thing goes up to 87.50 plus this dollar, let's say $1.60, $1.70, and that really is a big breakout. So that's where your speculators would be, but still you're getting a discount. That's worth $2.55. It's trading at say $1.65. Okay, $1.75 officially on the ask. So that's how we would play this breakout. We wouldn't do any covered calls because there's not a lot of volatility premium built into these. In other words, if this says 255 and the ask says, say, 340 or 350, now you've got some juicy premium in that you wouldn't want to overpay for the option. So you'd go ahead and buy the lower priced option, sell the upper priced option against it. It's a spread, it's a vertical spread, and you would hopefully pick up the decay on the selling premium and the upside on the stock moving up. But we're not talking about that kind of a position. This is just a naked call, a single call not really naked because you're not selling it, but you're buying a single call on the option and hoping for an upside. Okay, so that's how we would play NXPI. Of course, you could buy the stock depending on how much you have. You could either control 1,000 shares of NXPI for the next 6 weeks for $1,750. That's 10 contracts at $1.75 a contract, and one contract is worth 100 shares. So it's $1,750 to control that. Or you can go ahead and spend about $82,000 to control 1,000 shares of NXPI, and then you get the voting rights and the upside, and you don't get any time decay and all that kind of stuff. But we like the risk profile of doing options, so that's how we would recommend you play this trade.